Good morning, everybody. Thank you very much for being here. My worst nightmare is for someone to bring the tax book with them and say, on page 67, Shaz, on the fourth line, it says this, what does it mean? And the answer is going to be, it depends, you see. So, I've got some friends on this table here, it always depends. This evening, Michael and I are going to be in Ipswich, and tomorrow we're in Leeds and all over the place. I've written a number of books. The most recent one, which is on this particular table here, is all about property tax. So if you've bought a copy, well done and thank you. It's the best book you've read in the month of February, isn't it? By far. Ian definitely agrees with that. So grab a copy of that. It's available on Amazon. You're my best friend today. So there's 3 key questions to ask yourself every time you're looking at tax planning. The first one is it legal? Why do we want things to be legal, my friend? You don't end up going to prison, that's a bad idea. So we don't want to go to prison, number 1. Good. Number 2, it's effective. And the third one, which is the best one, is it acceptable? So let's say a particular person has bought a property for £750,000 plus VAT. Why would they pay VAT on the transaction when they buy? But why are they having to pay VAT? Because they're not opted out, they're not opted in either. But you're getting close. Anybody else? Jeff?
It's owned by a company that's VAT registered.
It's owned by a company or an individual. Yeah. And Jeff, why would that person be VAT registered? What's the obvious reason, do you reckon? Apart from being over the threshold.
Sole trade or something?
No. So what happened is somebody bought a property, a commercial property. They decided to refurbish it, and it was going to cost them, let's say, £100,000 plus VAT. They then say to their accountant, well, I want to claim the £20,000 back on the refurb costs. Okay, how do I do that? The accountant says, well, if you opt to tax, which means, okay, your building premises, okay, are now VAT registered, you get to claim back the £20,000 on the £100,000 refurb, but you have to do 2 things. One is charge VAT on the rent, and the second thing is when you sell the property, you have to charge VAT on disposal. So whoever buys the property has to pay you VAT. So this particular example here, the vendor had opted to tax, so they're charging £750,000 plus VAT. It's going to cost them £750,000 to convert this commercial property into residential flats. How much VAT do you pay when you do a commercial conversion from commercial to residential units? 5%. 5%, are you okay with that? Fine. 5%, yeah. Good. And if you buy, you pay 5% if you subcontract material and labour. If you buy the material yourself, then you pay 20% on the materials. Okay? So you've got to subcontract the whole thing. When you buy a property, in this particular example, you're paying 750 plus VAT, which is £900,000. You pay stamp duty land tax on the 750 or the 900 grand? 900 grand. So you're paying VAT, and then you're paying SDLT on the VAT. So it's tax on tax. So for your purposes, what you want to be thinking about doing is how could you potentially avoid paying the VAT, which I think I'll cover on the next slide. If you sell those units, you can claim back all the VAT. If you hold on to the units, generally speaking, you can't claim back the VAT. Why can't we claim back the VAT when we refurbish or redevelop a commercial property into a residential property and hold on to the properties? Why do you think we can't claim back the VAT? I've kind of given the answer already.
Because it's residential.
Sorry? You can't charge VAT on the rent. That's right. So therefore you can't claim back the VAT. Yeah? However, if done properly, and this is not easy to do, if done properly, if you set up a lease to another company which is longer than 21 years, you can claim back the VAT. Let's quickly do a diagram here to show you. But this has to be done properly, it can't be anti-avoidance stuff. So you have a company, company A buys the asset, company A is going to redevelop. Okay, it's redeveloped and it's cost £750,000 to redevelop. Okay, it's going to pay, that's going to be £37,500 VAT. So you spent £37,500 VAT, you want to claim that back. We already know if you sell the units, you claim back the VAT. If you don't sell the units, generally speaking, you can't claim back the VAT. However, if done properly, you have a second company here, this is company B. Company B is owned by company A. Both companies are owned by you. Over here. And you grant a lease longer than 21 years, then company A can claim back the VAT. Yeah? Now generally speaking, when you grant a lease, you have to pay stamp duty land tax on the net present value of a lease. But because company B is owned by company A, you get something called group relief. Therefore you do not pay any stamp duty on that. So you escape this and you get this back as well, yeah? So there is a way around it, it has to be done properly if you hold on to the units. Okay, let's have a look. So bought for 750, husband and wife bought the property together and they want to rent it out there, and we can answer your question after this if you like, my friend, because it's going to be linked to some extent. They obtain planning permission. When you obtain planning permission on a property, what happens to the value? It goes up. Okay, so hold on to that thought. Property value goes up, then at some point they can incorporate. We're going to cover incorporation in a short while, so in about 10 minutes time, Richie. Before I move on to the next point, if I don't mention incorporation, you're going to remind me, say, Shaz, incorporation. Yeah?
Yeah.
Good man. Rent it out as, so they refurbish and then they rent it out as service accommodation for a short while. If you rent a business as service accommodation, I think we were talking about it on the break, you can claim capital allowances. What kind of things do you think you can claim capital allowances on? So in this room here, have a go.
Radiators, tables, kitchens,
And the building itself, I think,
Yeah, things in the building, yeah. Things in the building, yeah.
and all the techniques you put in for refurb.
Yeah, that as well. That's right. So you've got two lots. So if you buy a building for £750,000, like we've established here, and then you claim, let's say, £150,000 worth of capital allowances. That's just a made-up number, by the way. Okay. You buy the property for 750. You claim 150 of capital allowances. Okay. Against the property. So you've got 600 remaining now. If you sell that property, say in 2 years' time, for £800,000, which figure do you pay capital gains tax on? 8 minus 750 or 8 minus the 6 if you claim the 150? 8 minus 6%? Who thinks it's 800 minus 600 because you already claimed the 150? And who thinks it's 800 minus the 750? Most people are unsure. Okay? It's 800 minus the 750. So the point I'm making here is, if you claim capital allowances, okay, for tax purposes, in terms of when you dispose your property, the purchase price remains the same as what you paid for it when you bought it. So now, unlike VAT and stamp duty land tax, when you're paying tax on tax, this is a double whammy for you. You benefit on the capital allowances and you benefit on the disposal. Everybody get that? So you and I buy a property and we pay 750 for it.
Yeah.
We then go to a switched on accountant, tax advisor, and they say there's quite a bit of equipment here, okay? The aircon, the lights, okay? Fire alarms, smoke, all that type of stuff. Radiators. So they work out, we can claim £150,000 worth of capital allowances. You're going to benefit because although you use up your capital allowances, okay, 150 grand, so you've got 600 grand left on the value of the property. For tax purposes, the value of the property remains 750. So you're going to save tax on the 150, but your value still stays 750. So your margin is going to be smaller as well. So you're going to pay less tax that way too. Yeah.